As each new day passes, it seems like more speculation around a market crash occurs. Dividend stocks have proven to outperform growth stocks in bear markets. Today, we will discuss step by step how to design a dividend stock portfolio, reviewing the desired structure of your dividend stock portfolio, the criteria for dividend stocks, where to find the best dividend stocks in 2021, and stock portfolio diversification in order to properly protect against a bear market. I'm Patrick Zimmerman, and today we're talking investing strategies and how to build a dividend portfolio in 2021. I recommend that your portfolio consist of about 10 to 15 different securities, whether these are stocks, preferred shares, exchange-traded funds, MLPs, REITs, and even bonds to hedge some risk. I believe 10 to 15 different positions is that sweet spot because the more securities you hold, the more difficult it will be to manage and keep up with the business practices of the companies you're invested in. It will also help you scale your positions over time as to not spread yourself too thin. In addition to investing into dividend stocks to protect yourself in bear markets, it's also important that your portfolio is properly diversified in an attempt to slow down some of those sharper price movements and volatility. And lastly, the dividend payout dates. If you plan on reinvesting your dividends and growing your positions over time, you may also be planning to take them as dividend payouts in the future. This is a good time to plan out the structure of your dividend payments, whether that be receiving multiple dividends at the end of certain months or attempting to receive payments each week. Although there are a multitude of different fundamental metrics which you should look at when choosing positions to take, we are going to focus mainly on 3 different fundamentals as dividend stock criteria to narrow down the desirable list. The first criteria to meet is a dividend yield of greater than 3.5%. The reason you want a dividend yield greater than 3.5%, at the very least greater than 3%, is because you want it to beat out that rate of inflation. If the company you're invested into pays a dividend of 1% and the cost of living increases 3% each year, then your buying power is slowly being eaten away by inflation. The second criterion you want to look at is the payout ratio. Payout ratios are calculated using many different numbers. I recommend you look at the cash flow, and you want it to be below 70%. The reason a dividend-paying company should have a payout ratio below 70% is because the lower the payout ratio, the more money they have to grow their business operations in the future. The last of the criteria is an average 10-year dividend growth rate of greater than or equal to 10%. I find this criteria to be the hardest to meet, so I give it a little leeway, but obviously you want to see a company grow their dividend. In just 1 minute here, I'll show you guys a surefire way to be able to find dividend stocks that grow their dividends each year at about a 10% rate. Before I do so, I want to remind you guys to hit that subscribe button and turn the notifications on to stay up to date on similar videos. And I also recommend you check out some of my stock analysis videos where we talk about some really safe dividend paying companies as well as some really high dividend paying companies. Now, there are a multitude of different fundamental metrics to look at before buying a company, such as the amount of cash they have and the debt they have on the balance sheet. But these 3 criteria should be used to create a list of more favorable companies. Then once you have a shorter list, you can really do a deep dive into the companies you already believe have successful business plans. One more thing to look at in addition to those 3 criteria are the sector and the financial industry of the companies on your list. The reason you want to take note of these is because it'll come in handy when we plan out the diversification later on in the video. The best tool I have found to narrow down dividend stocks based on the before mentioned criteria comes from the Dividend Investing Resource Center and is 100% free and easily accessible on the internet. You can find the Dividends Champion list at dripinvesting.org, and once you download it, you should be able to open it by using Microsoft Excel, or if you don't have access to this, Google Spreadsheets is a free alternative. Once you open up the Dividends Champion list, you want to pay attention to the tabs at the bottom, as they separate the vast number of dividend-paying companies into 3 separate categories. Dividend Champions is the first category. The Dividend Champions are companies that have increased their dividend every year for the past 25 years. Although these companies are the most stable, they do not generally offer much growth potential as they are incredibly established within their industry. Next up, we have the Dividend Contenders. In order to make it on this list, a company must have increased their dividend every year consecutively for the past 10 years. Dividend Contenders are my favorite group because these companies offer both safety as well as potential for future growth. Because of this, if you're looking for companies with larger dividend growth rates, I recommend this is the list you look on, as their dividend yields have been increasing for a lot less longer than the Dividend Champions list. Last up on the docket today, we have the Dividend Challengers. They have increased their dividend consecutively for the past 5 years, and will generally continue to do so in order to climb up the rankings. With this being said, sometimes they might have trouble with consistent dividend increases because they are not as established as companies with the two aforementioned titles. However, because challengers are generally newer companies, oftentimes they do have the largest potential growth. I want to remind you guys to look down below the video here and pay special attention to that subscribe button. While you're down there, you might as well slap the thumbs up too. Now, proper stock diversification focuses on 3 separate factors in my opinion. The first being diversification between individual positions. How many different stocks are you holding? The second important factor of diversification is that between sectors and industries. If you only invest in companies within the technology sector, then you're putting all your eggs in one basket. And lastly, you want to focus on diversification between security type, whether it be stocks, bonds, ETFs, real estate investment trusts, or master limited partnerships. Let me know in the comments down below what types of securities you hold in your portfolio and how many of each you like to focus on. In order to properly visualize the diversification of your dividend stock portfolio, I recommend using a spreadsheet of sorts and organizing your information similarly to this. List the desired securities alongside their respective financial metrics such as dividend yield, dividend payout ratio, and average 10-year dividend growth rate. Also, ensure there is a column here for sector and security type, as we will be weighting the portfolio in each of the 3 prior mentioned stock diversification factors. Lastly, if you would like to add a pie chart, as I recommend you do, you're going to need a column on the tail end here titled Amount Invested, as this column will be used to help you visualize the weighting. You can either fill it in with numbers you just make up, or what I've done is start out with an initial investment of $1,000 for each security, and I've calculated the growth over 5 years solely from dividend payments, without factoring in additional contributions, dividend growth, or an increase in share price. After you have the amount invested column filled for each of your dividend stocks and securities, you can make a separate pie chart for each of the 3 diversification facets which we have discussed: position size, financial sector, and security type. If you do not know how to do this, go to the Insert tab at the top of the screen, and the pie chart is an option around the center of the ribbon. It's important to note when creating charts for the financial sector and security type, you must create a separate table of information, as I have done down on the bottom of the spreadsheet. This is because you will need to calculate the summation of similar categories such as equity real estate sector or the stock security type. Now you got your portfolio all planned out, you invest into it. 1 year down the line, share prices have obviously changed. Your positions may have increased if those have been reinvested, and all of this affects the weighting of each position. Because of this, it's important to rebalance your dividend portfolio a few times each year. I generally recommend doing this every financial quarter. The reason this is necessary is because as share prices fluctuate and dividends are received, your positions will continuously change. The way I rebalance my portfolio is done very similarly to the process we just took on planning out this dividend stock portfolio. I just update my spreadsheet with the current dollar amounts which I have invested, allowing me to see the current weighting in the pie chart form. Then take the total amount you have invested in the market, and depending on how you divvied up your weighting, multiply the desired percentage by the total amount invested. For example, at the end of the year, if you currently have $10,000 invested and $1,200 of that is invested into the healthcare sector and $800 is invested into the technology sector, but you have a desired weighting of 10% in each sector, you would sell $200 of one of your healthcare stocks and then buy $200 worth of shares of one of your technology stocks. I really hope this video helped out some of the new investors who are looking to plan out their first portfolios and get their investing journey on the way. I hope this helps some of the more experienced investors who are looking for a way to protect themselves in the bear market. With in-depth analysis on multiple dividend-paying companies, you can check out my playlist here. I'll throw it up on the screen as well as in the description. On your way down to the description there, don't forget to smash the like button and give me a thumbs up on the video if you liked it. Leave me a comment down below letting me know how you diversify your portfolio. I want to thank you all so much for 100 subscribers. It really means a lot to me. As always, I'm Patrick Zimmerman. Thank you for your time. Have a nice day.